What if I told you there's a way to build serious wealth without spending all your time picking stocks or needing to be some kind of financial genius? It sounds too good to be true, right? But stick with me for a few minutes because this is simpler than you think. Imagine you start investing just $200 to $300 every single month, consistently for the next 20 years. Instead of trying to guess which individual stock will be the next big thing, you use a straightforward three-part strategy: ETFs, stocks, and bonds. Let me break down how this works. First up, we have ETFs, which stands for Exchange Traded Funds. Think of these as a big shopping basket of stocks. Instead of buying a share in just one company, you're buying a tiny piece of hundreds of companies all at once. A perfect example is an S&P 500 ETF. By buying just one share of this, you get instant exposure to the 500 largest companies in the US historically. The stock market has returned an average of around 10% per year. This is the core of your strategy, your steady growth engine. Next, let's talk about individual stocks. This is where you can get a little more targeted and aim for higher returns. We're not talking about wild gambling here. We're looking for strong, established companies, the ones with solid revenue, growing profits, and a clear vision for the long term. Yes, individual stocks can be more volatile, meaning their prices can swing up and down more dramatically. But if you choose wisely, they can really boost your overall returns and accelerate your wealth-building journey. And finally, we have bonds. Think of bonds as the anchor of your portfolio. They are generally much more stable than stocks and are designed to generate a steady, predictable income. They won't grow as fast as your stocks or ETFs, but their real value shines when the market gets rocky. During market downturns, bonds help protect your portfolio from big losses, giving you peace of mind. So, how do you put this all together? A simple, balanced portfolio could look something like this: 70% in ETFs for that reliable, long-term growth, 20% in a few carefully selected individual stocks to give you that potential for higher upside, and the remaining 10% in bonds for stability and protection. Now, let's run the numbers and see what this actually looks like. If you invest just $200 a month with an average annual return of 10% in 20 years, you could have around $150,000. Not bad at all, but what if you can stretch it to $300 a month? That number jumps to over $225,000. And here's the most incredible part of this whole thing. The vast majority of that final amount isn't the money you put in. It's compound interest, your money making more money for you over and over again. That's the real magic here. It's the power of consistency and time. You don't need a huge lump sum to get started. You just need to start, even with a small amount, and then stick with it. If you found this helpful and want more simple, effective investing strategies that actually work, make sure to subscribe to the channel. Thanks for watching.